Welcome back, students. Today we are tackling a critical pillar of personal finance, commercial stability, and risk management. Insurance. Introduction to insurance. Life is inherently unpredictable, and insurance is our financial safety net against catastrophic losses. Let's explore these structured, easy to understand notes together. What is meant by insurance? What is insurance? Insurance is a legally defined as contractual agreement represented by an insurance policy in which an individual or an entity receives financial protection or reimbursement against specified losses from an insurance company. In simple terms, it is a smart risk sharing mechanism. You pay a relatively smaller regular fee called a premium to an insurance company. In return, the insurer promises to pay out a much larger sum of money in an unfortunate event like an accident, illness, fire, or theft occurs. Policyholder, you, pays regular premium. Insurance company, pool for funds, pay larger claims during loss. Note, underlying concept, the law of large numbers. Insurance works by pooling the risk of thousands of individuals. Since only a tiny fraction of people will experience a loss at any given time, the money collected from everyone's premium covers the losses of a few who face disasters. Types of insurance with the definitions. Insurance can be broadly categorized into several distinct types depending on the nature of an asset of life being protected. Life insurance. A contract between a policyholder and insurer where the company guarantees payment of a designated sum to named beneficiaries like family members upon the death of an insured person, providing vital financial security to a dependents. 2. Health insurance. A type of coverage that pays for medical, surgical, and prescription drug and sometimes dental expenses incurred by the insured. It can either reimburse or the policyholder directly or pay the health care provider in kind. 3. Motor and auto insurance. A mandatory financial protection for trucks, cars, motorcycles, and other road vehicles. It provides the coverage against physical damage or body injuries resulting from traffic collisions and also covers the liability arising from injuries caused to third parties. 4. Property or home insurance. Coverage that provides financial compensation to owners or renters of structures in the event of damages caused by fire, theft, vandalism, earthquakes, or other specified natural disasters. 5. Travel insurance. A specified temporary insurance covers the mitigates financial risk associated with the traveling such as emergency medical evacuations, trip cancellations, delayed luggage, or lost passports intentionally. How is insurance useful? Without insurance, a single medical emergency or a property fire could easily force a family or a small business into absolute bankruptcy. Insurance is incredibly useful because it reduces stress and anxiety, gives an absolute peace of mind knowing that if things go wrong, you are not financially ruined. Maintains economic continuity. Helps business restart quickly after disasters, keeping people employed and economic stable. Promotes saving habits. Certain life insurance products accumulate cash values over time, serving as investment vehicle. How is insurance covered on anything? Can you buy insurance for absolutely anything? Yes, provided it possesses an insurable interest. You cannot insure a random neighbor's car because you don't suffer a financial loss if it crashes. To cover an asset, an underwriter assesses the risk variables today. Specialized entities insecure rare items, singers insecure the vocal cords. Soccer players insecure the legs, and companies buy cyber liability insurance to cover digital data assets against hackers. If it's have quantifiable economic value, it can be mathematically modeled and covered by an insurance company. Next is advantages of an insurance. Financial security and stability. Provides a concentrate fallback mechanism when an unforeseen crisis strikes. Risk transfer moves the heavy burden of catastrophic losses from your shoulders to a multi-billion-dollar financial entity. Legal compliance helps fulfill legal obligations. Example, commercial vehicle insurance is compulsory globally to drive legally. Easy access to credit. Banks often require property insurance coverage before approving home loans or commercial mortgages. Is insurance useful for medical purposes? Absolutely. In fact, it is practically indispensable. Modern healthcare systems are incredibly expensive. Healthcare costs can skyrocket into tens of thousands of dollars overnight for surgeries or chronic illness care. Medical insurance provides access to preventive care, covers hospitalization costs, lowers prescription drug expenses, and guarantees that you receive emergency medical attention without having to pay cash at the hospital counter. It ensures medical decisions are based on healthcare needs, not financial desperation. Government insurance agencies. Government insurance agencies are public sector institutions run, funded, or strictly backed by the state to provide social protection or fill gaps where commercial insurance is unprofitable. Examples include national social security programs, public health programs like Medicaid or Ayushman Bharat, crop insurance for vulnerable farmers, and state deposit insurance schemes protecting your bank deposits. Government versus private insurance agencies. Let's map out exactly how public state agencies differ from corporate commercial operators. Primary objective. Government. Social welfare and equity. The goal is to provide baseline financial protection to all citizens regardless to income level. Private. Profit driven and competitive. The main goal is to generate revenue and financial returns for company shareholders while delivering customer service. B. Premium pricing and accessibility. Government. Low uniform or heavy subsidized premiums, often heavily supported by taxpayers, and coverage cannot be easily denied due to pre-existing conditions. Private. Risk-based pricing. Premiums are custom calculated based on your age, lifestyle, health status, and claims history. Higher risk equals much higher premiums. Range of flexibility and selection. Government. Rigid, standardized, and one-size-fits-all policies. Offers very little customization room for an individual policyholders. Private. Highly flexible, offers an array of optional riders, adds-on, premium brackets, and global service hospital networks to match your exact lifestyle choice. Note: Faculty summary tip. A robust financial plan utilizes both use of government plans for foundational social coverage and supplement them with a customized private policies to fully safeguard your family, life, and hard-earned assets. Keep reviving them stuffs of your exams. Thank you.